Okay, this will start out here and just kind of talk about the pullback we've had this week. Um, it's not insignificant, but it's not greatly significant either. And so I want to kind of put it in perspective, bigger picture, because sometimes when you're looking at things by the day or by the hour or by the minutes, that looks pretty ugly. But let's just go to the markets to begin with. And the first place I want to begin here is obviously with the Dow Jones. We had this head and shoulders pattern. Remember, I said 60% of the time it's usually good news. It doesn't mean that it's over yet, but we had this candle this week, and these are weekly data. And so this is showing that we're down, 550 odd points over the past week. So it's been not a very good. It's not been a very good week. I kind of uh, expected some type of a pullback at this point. I just was kind of surprised to the significance on some of the stocks. The ones that have kind of held in there, the apples and you know um, the FANG stocks, I guess you could say, Meta, um, or Facebook would have been the F back in the day. Um, those stocks have held up fairly well this week. It's been more everything else, which is somewhat disappointing. It doesn't mean that they won't make a comeback. I was looking for kind of some momentum on getting some other stocks involved in what the FANG stocks have experienced over the past few weeks. And so you can see on these weekly data, obviously this has been a down week. I said 550 points. We look at SPY. We just recovered this, and now we're below it again. But you look at this, you get a bullish engulfing candle. So this is a candle, and it's bigger than this one, so it's engulfing the down one. Unless we have a real drastic sell-off here at the end of the day, it'll remain that way for the week. Um, the Qs, which have been running up, kind of the same story. IWM is kind of where the disappointment is from my perspective, which is, we work so hard to get some breadth in the market, and IW, the Russell indexes. There's a lot of small companies, and we've been trying to get them all involved to help kind of get this market going in a upward fashion, and it's just probably delayed at this point. I don't necessarily see any break in these bigger patterns on the larger indexes. So we've been kind of higher highs. We had this low here, but a higher high here. Kind of make it meandering our way up until today. And so going back to the daily data, it's disappointing, but you got to have some pullbacks too. We had a pretty good run there for a number of weeks to build this head and shoulders, and so it's not unexpected. We look at the 10-year Treasury note, which I think of this as a harbinger for almost all the interest rates, and we still have not filled this gap here and we may not. It may remain open, but we keep kind of inching closer. It might just go up there and touch it, or maybe a little beyond it. Still, with Powell's Fed Chairman Powell's comments that they're going to raise a couple more times this year, which I'll talk about at the end. And so, not terrible news. I mean, it wasn't a bad week, but it wasn't a great week either. Let's see what the wound up for the week. Kind of a doji, kind of undecided on what it wants to do at this point on the 10-year. We look at the DXY. It's kind of in this. I had expected this maybe to go up and touch this area about 105 on the dollar, I'm waiting for it to break either up or down here. Kind of things are kind of narrowing in on it. This kind of pennant pattern we've got working here. So we'll see what happens with the DXY. Kind of made a little bit of a comeback after a big down week last week. Crude oil was down for the week, kind of still in this pennant also, waiting for, are we going to break up, are we going to break down? And then the VIX continues to get crushed, although it was up a little bit today. It was still lower for the week, or should be by the end of today. Again, the markets are active right now. And then we look at the breadth. This is the thing I'm concerned about. This is where the Russell fits in with the stocks that are above, percentage of stocks that are above their 200-day average. And now we're below 50%. So we'd started to make all this progress up here, and then this week came, and you can see that's not what we wanted to see. Would like to have seen that meander its way on back up, but like I said, it was due for a pullback. Let's go to, I don't believe I covered investor sentiment last week, but you look at again, Wednesday night basically this comes out, and last week things got even more aggressive from a sentiment standpoint, where it had lowered, and now we're kind of popping back up. So that is relatively good news. We got more people that are now bearish. Kind of let this thing play out, but I have a feeling we may have to run this thing off a little bit because of the greed index here. Still, it's not an extreme greed anymore, which it was last week. We're at 74 now. I'm guessing after today that'll probably run down a little bit more, and hopefully this will make its way more. I don't know if we need to make it to fear, but something maybe neutral. After today, we'll see how it reads. And as far as the economic calendar goes, this past week, we had building permits came out. They came out a little bit stronger than expected. Housing starts definitely was stronger than expected. And, we were minus 2.9. Just kind of take a look at this month over month. Whoa, what happened there? And I think expectations are that the interest rates will continue to go up. So people are trying to get locked in. And you can see that on Wednesday that, the mortgage rate was down just a little bit from the previous week. But, housing starts, much more than what was expected. So it's an interesting environment now. We still have lots of, low unemployment, and that's kind of leading to some of these numbers being able to afford a house. And we have the initial jobless claims were a little higher than expected. We're starting to see this number be higher than what the consensus is. We had a whole slew of people. Fed Chairman Powell was in the House. I listened to that. I listened to a little bit of the Senate on Thursday. Nothing really new, other than saying he's going to raise it. They plan on raising maybe 2 more times this year, and starting in July. But I think it's going to depend on some of the numbers that we wind up getting next week. Before I look at that, the S&P Global Manufacturing PMI was below expectations, 48.5, 46.3. And the S&P Services was pretty much in line with what they thought it was going to be, and lower than the previous period. And so, things continue to weaken just a little bit at a time. Maybe not fast enough for the FOMC. But we take a look at next week, and we have the Dow Manufacturing Index. Again, these are numbers that continue to get crushed. Then we have durable goods orders. That could be a market mover next week. New home sales, obviously. We get the new mortgage rates out, which should probably be just a little bit higher. We'll have more he must be somewhere because I noticed he had a, 7 a.m. you know, or 2:30 a.m. speech. So I don't. He may be over. No, that's even early for Europe. Maybe it's a place like Australia next week. But we'll get any idea of the GDP growth rate, pending home sales. But the big one's going to be Friday. Let's just be honest. Personal income and spending is still significant. You'd like to see those numbers start to come down a little bit. For where the Fed would like to see that, but the core PCE is obviously is going to be what drives the what the Fed does. If this number comes in really light, which we can always hope, maybe a 0.2% or something lower on the PCE month over month, maybe a year over year, something in the threes, would definitely be a win to the back of the markets. And then you get the Michigan Consumer Sentiment final, which was 59.2. They're expecting that to go up to 63.9. All of those will have a role to play in what the Fed does is the next meeting in July. And my expectation would be, if it's pretty much in line, if it's 0.4%, let's say this is 4.3 to 4.5, they're going to raise. If we get something a lot less than that, then they may have to reconsider. But my final comment has to do with this website. It's called Truflation. I thought it was very interesting. Some people were talking about it on Twitter, and I thought, gee, this is kind of makes sense. You can go and read it on your own, and I could go through all of the definitions, but you can read about the methodology it came up with. But their whole spiel is basically that the CPI numbers are not based on really modern information, and so they've kind of rebuilt the inflation and said basically no, it's not 4.4% or what the numbers that we see every week. It's more like 2.38%. And I just did a episode on my business channel, kind of helping businesses prepare for what might be coming, whether it's inflation or deflation or whatever. But this quarter, I talked about deflation, and I used this because, with the Fed funds rate at 5.5%, or looking at being, increasing another 0.25%. I think Fed funds rate is running about 5.5%, somewhere in there. And, they're saying, well, we got to get this inflation down, those types of things. And then you get somebody comes out with kind of maybe a more modern way, a better way to do the inflation rate. Now they're saying it's 2.38%. Well, okay. Then we're getting close to whatever target that the Fed chairman has said, 2%. So I'm kind of keeping an eye on this, and go to Truflation.com and do it on your own. But it's coming down pretty rapid. They had it up here around 11.57%, and now they have it 2.38%, but dropping. Some ups and downs, but for the most part, that's a downtrend. And so you might be looking in the next, I don't know, you were at 4.5, down 1.7%. You could be close to zero by the end of the summer or lower as far as using these particular numbers. But I think it's something interesting to watch. They do a pretty good job. You can go through each of these categories down here, what they're seeing, transport, utilities, health, alcohol and tobacco, clothing, all these things, all these categories that make up their inflation rate. I think they do a pretty good job of tracking it. So it's just something to kind of keep an eye on, because if this goes below zero, then we start to have the conversation about deflation and what is the Fed doing, basing what they have, not only looking in the rearview mirror, but looking at numbers that aren't really helpful to them in making their decisions about, do I raise rates? Do I, um, leave them as they are? I mean, they've raised them so fast, probably the fastest in history, and trying to cut QE out, you know, I keep saying something's going to break, and if the expectation holds that we get a bust after this may be the reason. This is what David Hunter has been calling for since last year. Ultimately, that we would get a bust, deflationary bust, and this kind of supports his thesis around, or his forecast, saying that they've over tightened and it's too late for them really to do anything now. So they'll be doing a lot, once the bust happens. So anyway, I think it's a good idea, whether you're in business or you're in markets or whatever, kind of keep track of different perspectives, different views on things like inflation. This may be more representative, and take a little bit of time, read the methodology, keep track. It's something I'm going to go back to. I don't know about daily, but probably once a week, and just kind of see how it's progressing. So that's what I wanted to cover this week. And just like the Truflation website, there's always a better way.